Welcome back. Today, I'd like to talk about the property, plant and equipment, accounting for them. So these assets, they are intangibles. So if they are intangibles, what are they? So we can define them as they are assets that are held for use in the production of supplies of goods or services for rental to others or for administrative purposes. Also, they are expected to be used during more than one period. Also, the cost of item of property, plant and equipment shall be recognized as an asset if and only if 1. It is probable that future economic benefits associated with the item will flow to the entity, and as well the cost of the item can be measured reliably. So those are all what we can talk about the tangible items, the assets, or its definitions. So let's continue with the definition. We have the measurement and recognition. So if you want to recognize this asset, so its measurement at recognition, we define it as an item of property, plant and equipment that qualifies for recognition as an asset shall be measured at its cost. It have to be measured at its cost. Then you have the measurement after recognition. An entity shall choose either the cost model or the revaluation model as it is accounting policy and shall apply that policy to an entire class of property, plant and equipment. So what about cost model that we have seen above after recognition? So after recognition as an asset, an item of property, plant and equipment shall be carried at its cost, less any accumulated depreciation and any accumulated impairment losses. So that is what we call cost model, or what we define cost model. What about revaluation model, also recognized after recognition, the measurement after recognitions. So this one, revaluation after recognition as an asset, an item of property, plant and equipment whose fair value can be measured reliably shall be carried at a revalued amount, being its fair value at the date of the revaluation less any subsequent accumulated depreciation and subsequent accumulated impairment losses. So that is revaluation model. Then we have the residual value of an asset. Is the estimated amount that an entity would currently obtain from disposal of the asset after deducting the estimated cost of disposal, if the asset were already of the age and in the condition expected at the end of its useful life. I hope we are together. Please write some few notes on this. You can as well screenshot as we go on, so that we will be on the same track. Let's look what is depreciation. Is the systematic allocation of the depreciable amount of an asset over its useful life, or is the diminution in the value of asset due to wear and tear or due to just passage of time? So that is depreciation. So what are the factors that cause depreciation? So we have various factors that can cause depreciation, but we are going to look at a few. So one that causes depreciation, we have wear and tear due to actual use. So a machine can wear. You have the efflux of time or the mere passage of time. Then obsolescence, this is outdated, or a new invention or a permanent change in demand may render the asset useless. We also have the accidents, or falling market prices. So these are the factors which will obviously cause the depreciation to happen. So I'll give you a few minutes. Let's continue. The basic factors in depreciation calculation. So in order to calculate the depreciation, so you have the basic factors that we have to consider. One is the cost of the assets. So the cost of the asset must be considered. Then the estimated residual or scrap value at the end of its life. Then the estimated number of years of its life, they have to be considered, and these are years which is likely to be used by the farm. So they are the exact years of its useful life being used by the farm. What are the objectives of providing depreciation? So what are these objectives that will help in providing depreciation? First, we have to ascertain true value of asset and financial position. So that is one of the objectives of providing depreciation. So it ascertain the true value. Then make provision for replacement of honored assets. So assets have to be replaced. To calculate correct amount of profit or loss. So the profit and loss calculation, you have to show the expense or cost incurred to earn revenue must be charged to the profit and loss account for the purpose of correct computation of profit. Then you have to compute cost of production. So you have to compute the cost of productions. Comply with the legal provisions. So you have to comply with the legal provisions as well as to avail of tax benefits. So it will show more profits if depreciation is not charged on assets. So the income statement can be overstated. Let's go ahead and look at the methods of providing depreciations. So we have various methods of providing this depreciation. So we shall look at a few. So first, we have what we call fixed percentage on original cost, or fixed installment, or mostly it is known as the straight line method. So this one is a suitable percentage of original cost is written off the asset every year. So a suitable percentage, it is constant, it is written off every year. So its formula, it is cost minus the estimated scrap value all over the estimated life of that asset. Then you have the second one called fixed percentage on diminishing balance, or the reducing balance method. Here, a rate or the percentage of depreciation is fixed, but it applies to the value at which the assets start in the books in the beginning of the year. So the balance at every beginning of the year, it is the one that is going to be used to calculate the depreciation. Then we have another one called sum of the digits method. So the sum of the digits method, the formula, it is the remaining life of the assets, including the current year. You divide by the sums of all the year, sum of all the life of the asset in year. Then you multiply by the cost of the assets. So you are going to get the sum of the digits method. Then you have the annuity method. This one takes into account the interest lost on the acquisition of the assets. So this one involves the interest lost. Then you have revaluation method. It is used only in case of small items like cattle or loose tool, where it may be too much to maintain an account of each single item. We have depletion method. So this one is used in case of mines, quarries, or an estimate of total quantity of output likely to be available should be available. So it is used in to calculate the depreciation of mines, where you have all the total output. Then you have the machine hour rate method. Instead of the usual method of estimating the life of machine in years, it is estimated in hours. Here we estimate in hours. Then we have the repair provision method. So to the cost of the asset, we raise its estimated scrap value. The amount expected to be spent on its repair and maintenance throughout its life should be added, and the sum then divided by its estimated life. So here we are going to get the cost of the asset, we raise the scrap value, then the amount expected of that repair throughout its life should be added, and the sum then divided by its estimated life. And then we have revaluation of non-current assets. We had repair provision method. The next one is insurance policy method. So this one refers to the system that insurance company used for handling, issuing and managing insurance policy. Then the last one, it is depreciation fund method. A fixed amount is debited every year to depreciation account or profit and loss account. It is credited to depreciation fund account instead of asset account. So the asset is shown at its original cost in the books in every year. So here we are dealing with the depreciation account, which is credited to the depreciation fund account instead of the asset accounts. Wow. That is what all about the methods that we can use in calculating depreciation. So let's look at the revaluation of non-current assets. So non-current assets are held by an enterprise for the purpose of producing goods or rendering services, as opposed to being held for resale, the normal course of the business. So the purpose of revaluation is to bring into the books the fair value of the fixed assets. We are together. If you have any questions regarding any of the subtopic, please comment below and we are going to look at it. So we also have the reasons for revaluations. So why do we do revaluations? First is to show the true rate of return on capital employed on these non-current assets. Then to show conserve adequate fund in the business for replacement of fixed asset at the end of their useful lives. So you have to conserve adequate funds. Another one is to show their fair market value of assets, which have considerably appreciated since their purchase, such as land and buildings. Also, to negotiate fair price for the assets of the company before merger with the acquisition by another company. Another reason is to enable proper internal reconstruction and external reconstructions. Another reason is to issue shares to existing shareholders. Also, to get a fair market value of assets in case of sale and leaseback transactions. Also, when the company intends to take a loan from the bank's financial institution by mortgaging its fixed assets. We also have sales of an individual asset of group of assets. In financial firms, revaluation reserves are required for regulatory reasons. Also, to decrease the leverage ratio, the ratio of debt to equity. So that is all about revaluation. Now let's look at the property, plant and equipment movement schedule. So the property, plant and equipment schedule is a summary report on the balance and transaction of the assets and provision for depreciation account as per the requirements of IAS 16 to be reported in the published accounts of company. So that is all about the property, plant and equipment. So the format is as follows. So we have the title, the property, plant and equipment movement schedule format. So we always have the cost variation, so and the non-current assets. So we have the freehold property, leasehold property, plant and machinery, features, furniture and fittings, as well as the total. So we start with the balance at the year. So we can estimate that is 1st January 001. So all the balances of all the properties. So for the leasehold, we can have the long lease and the short lease. Then all the additions, any addition that we did and its total. All the revaluation gains, all the revaluation amount we did that year. Reclassifications, all we did, all the disposals, and then balance us at that 1st December of that year. Then below we are going to discuss on the depreciation or the amortizations. We have the intangibles. So the balance as at January that year, let's assume it is 2010. So we can have all the balances, then charge for the year. So we are going to calculate that so that we bring all the amount for the charge for the year here. Then we have the revaluations and also the eliminated on disposals. So all the elimination on disposals. Then the balance at 31st December of that year, 01, and also we have the net book value for the previous year and the current year. So we are going to get all that. So in order to understand this, we shall tackle a question and we see how we can handle this. So this is the formula, and necessarily not all the cost variations that we put. Some we skip. So during the reclassification, there is where some of the non-current assets are transferred into different classes, e.g. some properties held under long leases over 50 years would be transferred to short leases classes when their term becomes less than 50 years. So this is all about the reclassifications. So we have the long leases, the property are transferred from, if they have 50 years and more, to short leases less than 50 years. So that is what we call the reclassifications. So let's continue. Then we can also talk about the control accounts or the total accounts. So the control, they control a section of the ledgers. So they contain totals of posting to the individual or personal account which it is controlling. So those are what we can say about the total accounts. So let's start with the first one, the sale ledger control account. So this one can also be known as trade receivable control account or a total debtors account. So it contains all entries for the total of all items posted to the individual debtors account. Okay, its format is as shown. So on the debits on the left hand side, you have the balance brought down of the total debit. Then we shall also have, so this total debit, the balance brought down, it's the total debit balance from the previous period. Then on the left side, we also have the final credit sale for the period. So the final credit sale, we also have the refunds to customers, bad debts recovered, and also dishonored check. So those are the things that we put on the left hand side. On the right hand side, credit side, so we have all the total credit balance of sale ledger brought forward. So the total credit, then you have the cash received from debtors. You also have check received from debtors, total return inwards, discount allowed, bad debtors written off, cash received from bad debts recovered, allowance to customers, purchases ledger contra. All these are on the credit. So we shall have the total debit balance carried down, and also on the left side we shall also have the total credit balance carried down. So they shall be like that. So this is a format. So we shall also have to handle a question so that we shall get all there to understand this. So let's look at the other one. It is known as the purchase ledger control account. So this one can also be known as trade creditors control account or the total creditors account. So this one contains all the entries for the total or item posted to the individual creditors account. So this one is individual creditor accounts. So the formats is also as shown. On the left hand side, how you have the debit, we shall start with the balance brought down for the total debit balance from the previous period. So this one will also start from the previous period. Then we have the total checks paid to creditors, total cash paid to creditors, total cash discount received, allowance by suppliers, sale ledgers, contra, and total return outwards. So on the right hand, we have on the credit side, we have the total credit balance of the purchase ledger brought forward. Then you have the total credit purchase from journal, also referred from suppliers. So on the right hand side, we are going to get the total debit balance carried down. On the left hand, total credit balance carried down. So this is a format. We also going to handle an example so that we get all the information. I hope everyone is cool and we are together. Please ask any question on the comments and I shall come back to you. So let's continue. Then let's look at reasons for maintaining control accounts. Why do we maintain these control accounts? So first is to ensure arithmetic check on the accounting records. So we have to ensure the arithmetic check. Then in case of incomplete records, you'll have to understand on that. Then provides a quick figure for total balance as at a given time to be reflected in the statement of financial position as debtors and creditors respectively. It also helps on that. Also help in detect and prevent fraud in the suppliers and the customer accounts. Also facilitate allocation of duties among the debtors and creditors handling staff. Let's look now at the cash book and bank reconciliation statements. So the cash book for cash at bank records all the transaction taking place at the bank. That is the movement of the account held with the bank. So this one, items appearing in the cash book are not reflected in the bank statement. We have to unpresented checks. So these are checks issued by the firm for payment to the creditors or to other suppliers but have not been presented to the firm's bank for payment. Uncredited deposits or checks. These are checks received from the customers and other sources for which the firm has bank, but the bank has not yet availed the funds by crediting the firm's account. So those are the two that we usually use to help us in the reconciliations. So what are errors made in the cash book? So we have also errors that can be made in the cash book. So we can have the payments over or understatement. Then deposits can be also over or understated. Then we also have deposits and payment misposted. Then overstating and undercasting the balance carried down in the cash book. All those can be errors found in the cash book. So let's look at the bank reconciliation items. So we have various. We can check on the deposits interest. So this one, so mostly company will make frequent cash deposits. So company we have to record to show one or more deposits. So this one will also be shown in the reconciliations because they are frequently deposits made by the company, which will not appear on the bank statement maybe. Then you also have outstanding checks. So the outstanding checks also will be part of the reconciliation item. Then you also have automatic withdrawal and deposits. You have to check on that because company may authorize a bank to automatically transfer funds into or out of their account. Then you also have the interest and bank services charges, which can be banks are required to pay maybe to the customer to pay monthly account fee, check printing fee, safe deposit box, rental fees and other fees. All those have to be catered for. NSF, not sufficient fund checks. So this one, they have also to be recorded because a check previously recorded as part of the deposit may bounce because there are not sufficient funds in the issuer's checking account. You can also have the errors. So those are the reconciliation items. So let's look at the format. We start with the bank reconciliation statement as at that year or that period of time. Then we have the balance at bank as per cash book updated. So we have to update that the balance on the cash book. Then we have to add the presented checks, unpresented checks, errors on bank statements. So this one, they are going to effect on the increase on the balance at bank. So this is the errors which are affecting the increase on the balance at bank. So we add that. Then we less uncredited deposits. Then we also less the errors on bank statements. These are errors which affect or effect on decreasing the balance at bank. So that is the first format. We can also have the second format whereby instead of adding unpresented check, we start with the less uncredited deposits, errors on bank statement, then we come add the unpresented checks and errors of the bank statements. So you can put these two in two ways. So you can start with this upper part of unpresented checks, or you can also start with the uncredited deposits. You add them and then you raise the other part. So that is all about the bank reconciliation format. And mind you, when you take one format, you have to you have to understand it properly, because in here where we have the unpresented checks, so if you start with this format as shown, you have to go all the way to the end with it. If it's the second option, you have to add the uncredited deposits and errors on banks statement, then you less the unpresented checks and errors on bank statement all the way to the end. So you don't need to mix them. You have to take a group and another group separately. So you can utilize this format, or the one that I've explained, whereby you start with the adding the uncredited deposits and erasing the unpresented checks and the errors of the bank statements. So let's continue. So I want to discuss about the overdraft. So for the overdraft, we can talk about this is the negative bank balance. So this one, an overdraft occurs when money is withdrawn from the bank account and the available balance goes to below zero. That's why I'm talking about the negative balance. So which are the reasons for overdraft? Intentional short-term loans. So that is also another cause. Then failure to maintain an accurate account register either by the firm. Then ATM overdraft, you also have that. Temporary deposit holds. This one, a deposit made to the account can be placed on hold by the bank. We also have the unexpected electronic withdrawals. Then we also have authorization holds. Then the bank fees, and then the bank is intended to the customer benefit. So those are understand. So anybody having a questions as we continue? So the first example that we can look, it is about the accounting treatment and depreciation. I've discussed that, but I'd like to look at the one example. So the group separately. So you can utilize this format, or the one that I've explained, whereby you start with the adding the uncredited deposits and erasing the unpresented checks and the errors of the bank statements. So let's continue. So I want to discuss about the overdraft. So for the overdraft, we can talk about this is the negative bank balance. So this one, an overdraft occurs when money is withdrawn from the bank account and the available balance goes to below zero. That's why I'm talking about the negative balance. So which are the reasons for overdraft? Intentional short-term loans. So that is also another cause. Then failure to maintain an accurate account register either by the firm. Then ATM overdraft, you also have that. Temporary deposit holds. This one, a deposit made to the account can be placed on hold by the bank. We also have the unexpected electronic withdrawals. Then we also have authorization holds. Then the bank fees, and as well as paying the fraud. So where the account holders make a debit while insufficient funds are present in the accounting, believing that they will be able to make some deposits at the end before the debits clears, and they do not do so. So those are the reasons for the overdrafts. We also have the return check deposits. So account holder deposits a check or money order, and the deposited item is returned due to non-sufficient fund, or either closed account or being discovered to be counterfeit, stolen, altered, forged, or that. We also have another reason for overdraft: intentional fraud. Then we also have the bank errors, victimizations. The account may have been a target for identity theft. Then we also have the intraday overdraft. This one occurs when the debit in the customer account resulting in an overdraft, which is then covered by a credit that posts to the account during the same business day. So those are the reasons for overdraft account. So for now, I think now we shall look at some of the examples so that you can be able to understand. So anybody having a questions as we continue? So the first example that you can look, it is about the accounting treatment and depreciation. I've discussed that, but I'd like to look at the one example. So when we are accounting for depreciation, there is this account that we introduce called provision for depreciation. So we have to debit the P&L account and we credit the provision for depreciation account. So that is another account that we introduce during depreciation. So let's look at the illustrations. So a company start a business on 1st January 1999 and the financial year ending being 31st December. Here you are to show the plant account, provision for depreciation account, and then the balance sheet extract for each year, 99, 2000, 2001, and 22. Then the machinery bought was on January 99, we have the for 8,000, 2,000 we bought two, each for 5,000 on 1st July. Then 1st October another one for 6,000, and 201 we don't have, 202 another one for 2,000. So we are told that depreciation is at a rate of 10% per annum. We use the straight line method. Rand being depreciated for each proportion for the year. So this is the straight line method that we are going to use. So for solutions, so I'd like you to take a snippet for the questions so that you can be able to move together. So I think you have done that. So let's find the solutions. So we are being told to prepare the plant account. So let's start with the plant account. So this is the plant account. We are going to have two sides, the debit and the credit. So on our cash book in 1999, we are going to show on 1st January we bought a plant costing 8,000. So on December we shall credit that the balance carried down of 8,000. I think we are together. Then on 2,000, on 1st January, the balance brought down on our cash book is 8,000 from the previous year. Then on 1st July, we bought two plants. So on our cash book, we shall write 10,000. Then on 1st October, we also bought another one for 6,000. So the total will be 24,000. So this is what we are going to carry down to that 1st December. Then on 2/1, we did not have to buy anything. So the balance brought down from the previous year shall be 24,000. So this is 1st January. And then we also have the balance carried down will be that 1st December. So that is 24,000 shall be the same. On 2/2, the 1st January, we shall bring what we carried down from the previous year, so that is 24,000. Then we also on 1st April we bought another one for 2,000, so that is 26,000. At the end of the year we shall have carried down 26,000. So this is the format or the what we are supposed to do for plant account recognitions. You can take a screenshot. Let's go now to the second thing. We are asked to calculate the provision for depreciation account. So you have to show that. So before that, let's calculate the depreciations. So let me show you. So we are going to calculate the depreciation, which will help us in providing the provision for depreciation of account. So we shall start with the first year. We have been told that the depreciation rate is 10%. So 1999 will be 8,000, 10 over 100. It was bought on 1st January, so it is under 12-month period. So 12 over 12. So that one is going to give us 800. So the accumulated depreciation will be 800 for that year. So then we go to 2000. The same plant was there in 2000, so we calculate another depreciation for that account, for that plant, for 8,000, the 10% for the next 12 months, so it will be 8,000. Then on 1st July we bought 2 plant, 5,000 each, for that is 10,000. So the period was 6 months since it was bought on July, so it will give us 500. Then we also bought another one on 1st October, which is going to give us 3 months. So we get 6 months of 10%. In 3 months 150. So we add the depreciation here. We are going to get 1,450 as the accumulated depreciation. On 2001, we saw it is we carried down 24,000 for all the items. So we calculate the depreciation using the whole 12 month. So we are going to get 2,400, and also in 202 we shall also calculate the balance brought down for 24,000 for the whole year, which is 2,400, and also the 2,000 which we bought and planned from 1st April, so that is 9 months. So we shall get 150. We add to get 2550. So the total accumulated depreciation will be 7,200. So this is all about the calculated depreciation. So any questions as we continue, please indicate on the comments. So you can like that as well as get a screenshot as we continue. So that now we get to show the provision for depreciation account. So for provision of depreciation account, we are going to use what we have calculated in the depreciation amount. So we shall have two sides. We call that on the left hand side the debits and the credit. So we shall introduce the income statement on the P&L. So we saw that we were to debit the P&L and also credit the provision of depreciation. So in 1999, the balance carried down is 800, as we have seen from accumulated depreciation. So on the that 1st December, we debit that 800, and as well we put we credit on the income statement 800. Then on 2000, that 1st December, balance carried down will be 2250 because on 1st January we brought down the 800. We are going to credit this side. So, and the income statement we saw on our calculation for depreciation was 1450. So when we add both of them, we are going to get 2250, which is the balance carried down on 2000. So as well on 201, the balance brought down will be now the 2250. As well, the accumulated depreciation was 2400, which we are going to state it on the income statement. So total 4650. That is the balance carried down on our debit side. In 202, the balance brought down will be 4650 plus the income statement, which we saw was after calculating, which will be credited on 2550. So the balance carried down will be, starting these two, will be 7200. So they are going to be equal. So this is the provision for depreciation. You have to show the income statements as well as the provision for depreciation. Since we were debiting the income statement, when we come to provision of depreciation, we are going to credit it. Okay, any question from that? Let's continue. So our last thing that we are being asked is to provide the balance sheet extract for the year 1999 all the way to 202. So the balance extract. So these are non-current assets. So we are going to write the non-current asset. We have the cost, their cost, actual cost, accumulated depreciation, and the net book value after we have subtracted this. So in 1999, the plant we bought was for 8,000. 2000, the plant accumulated the total cost was 24,000. 201, we never bought anything, the total cost was 24,000, and as well as in 202 the total cost was 26,000. So this, we are getting this from the plant account. If you can remember the plant account that we generated in our first question, this one. So these are the plant account or the cost that we are looking. Then we are going to get the cost from the accumulated depreciation. Accumulated depreciation, we are going to get it from the calculation that we have done from the calculating the depreciations. So you have to no, the accumulated depreciation, we are going to get them from the provision of depreciation. I'm sorry for that. So as you can see, the depreciations account or the provision for depreciation, we have 800, 2250, we have 46, and we have as well as 72. So since our cost is their total, also the accumulated depreciation need to be also in total form. So in 1999, our total was 800. So the accumulated depreciation is 800. When you subtract, you get 72. In 201, total 24. Total accumulated 2250, which give us 21,750. In 201, we have 24,000. Our total carried down was 4650. So we subtract, get 19,350. The last one was 26,000, and our total was 7,200. When you subtract, you get 18,800. So this is the balance sheet extract that we are going to do, or that is what you are supposed to do. So you can get some note on this as we continue. So a minute on that. So let's continue. Another thing that I needed us to look is the property, plant and equipment movement schedule. I gave you the format, but I'll now like we look at the illustration. So we have the chief accountant of Jivunia Limited has encountered difficulties while accounting for fixed asset and the related depreciation in the company's draft account for the year ended 30 to 1. He has decided to seek your professional advice and presented the following balance of fixed assets at May 2010. So we have the acquisition cost, accumulated depreciation and depreciation rates. So furniture, trucks, plant machinery, land and buildings, their cost, accumulated and the depreciation rates. Additional information. It is the company policy to write off cost of the asset using above percentage on costs. Then depreciation is fully charged in the year of acquisition and none in the year of disposal. Then you have a 3-year-old machine acquired for 187,500 or sold for 15,750. It has been decided to adjust and charge depreciation on buildings at 4% in 5 years. I used the delivery truck purchased 3 years ago for 248. 250 was traded in during the year at a value of 157,500 in part exchange for the new delivery truck costing 450. Large building and machinery were acquired for 1,350,000 from a company that went out of business. At the time of acquisition, 90,000 was paid to have the asset revalued by a professional qualified valuer. The revaluation indicates the foreign market values. You have the land 900, buildings, machinery 300. So required a schedule of movement of fixed asset as required by the chief accountant for inclusion in the company accounts for the year ended 30 April. So getting the screenshot for this, we are going to have to do, and we do the plant equipment movement schedule. So we have, there are 3. So we have the cost variation. We have 3 non-current asset. We have the large building and machinery, and then we are going to combine them. Then we have the furniture on its sides, the motor vehicle, and then the totals. So we are going to start with the balance as at May 1st, 2010. So the balance as that was 13,007,500 for large building and machinery when you add all of them. So for furniture, we have 900. Its cost, motor vehicle, 3,525,000. And so the total, excuse for that, for the total, we have 17,512,500. And then we have the additions. We can start with the additions where we are being told that large building and machinery were acquired for 1,350,000, so we shall write that. Then we also have the motor vehicle. A new truck was obtained for 450. So those are the new additions. The total become 1.8. Then we also have the revaluation gains. So to calculate this, we are told that the large building and machinery were acquired for 1,350. 1,350,000. But as you can see above, after the revaluation, we had 900 for large buildings, 600, and machinery and 300. When you add this, become 18. 1,800,000. So we have to subtract the total of from 1,350,000 of what we had acquired. So the revaluation gain that we are going to get, it is 450. We don't have any other revaluation gain for the other two. Then we also have the disposal. A 3-year-old machine acquired for 187,500 was sold for 15. So we are going to dispose that. And then also motor vehicle that was purchased 3 years ago for 248,250. So we are also going to subtract that. So we also have to get their totals. So balance at 30 April 2011 will be beyond this to get 14,700,000. Here you have 9,300, 7,026 and 750 as well as the total of 19 million. So we go to the next part of depreciation and amortizations. So here we are going to start with the balance carried done as of 1st May 2010. So in our question, we are being told that the balance carried done for the land, building and machinery, when you add all of them, we get 4,755,000. Then you also have for furniture, which is 300,000, and also you have for truck or the motor, which is 1,470,000. So these are the accumulated depreciations. We can call them the balance since we are looking at the depreciation. So these are the balance on that date. So we are going to calculate the charge for the year. So the charge for the year, this we have to work out elsewhere. So that will bring the amount on the list. So I can show you how I have done for each of one of them. So we are going to start with the for the land, we are being told that it has a depreciation rates for nail. So we are not going to calculate the depreciation for land. So we are going to calculate for building, machinery, furniture and motor vehicles. So let me show you the calculation or the workings. So these are all the workings that I have done. So we start the depreciation on the furniture, which we had the 900. So the acquisition cost 900,000. So the rate is 12.5. So we get 112,500. Then we have the depreciation on disposal of disposed. So we are told that a truck purchased for 248,250 was disposed was purchased 3 years ago. But we are told that depreciation is free charge in the year of acquisition and none in the year of disposal. So for the 3 years, we subtract the 1 year that was for disposal. So we are going to calculate it for 2 years. So depreciation rates, it is 25% times the cost times the 2 years. We get 124. So that is for the depreciation on disposed delivery truck. Then we also have another calculation for the motor vehicle. So the motor vehicle, we are going to get its cost here. So this is the balance after we have the total. We have added the new truck and as well as disposed. So this is the amount that we are going to use to calculate the depreciation, which the depreciation rate is 25%. 10%. So we are going to get 931,557.50. So that is for the motor vehicle. Then for the buildings, we are going to calculate for two scenarios. First, we are going to calculate at 4%, the one that we have been given, because we are told it has been decided to adjust and charge depreciation in buildings at 4% for 5 years. So since we are not calculating the year of disposal, so we are going to calculate at 4 years within the 5 years. So the 4 years for the total for building was 2,925,000. So times 4% times 4 years, we get 468. Then, but in the question, we are given the depreciation rates was 2.5. So we calculate the same with the 2.5 rates, we get 295,500. So in order to get the correct amount, we have to subtract the adjustment of 4% and the one that we are given for 2.5. We get 175,500. Then we are also going to calculate now the total amount for the building. We had 2,925,000. Then we also acquired for the buildings that we acquired had a value of 600,000. So we add both times the 4%. So we get this 141,000 for that year, since this one was for the year acquired. So we shall add 141,000, 175,500. And since we also indicate machinery, we have to calculate the machinery costs or depreciation charge for the year will be its cost or the additions, then you subtract all the disposals. So the machinery was 7,387,500. We added we acquired a machinery for 300,000. We had disposed that one for 187. That is 3-year-old machine, 500. So our total was 7,500,000. So we multiply by a depreciation rate, which is 10%, we get 750,000. So, and finally, we also have to calculate the depreciation of disposed machine. So 10% of the depreciation of disposed machine was 187,500. So, and it was for a 3-year-old machine acquired. Since we are not calculating the year of disposal, we are going to multiply by 2 for the year of the 2 years, which we shall get that 7,500. So for the large building and machinery, we are going to add 750, 175,500, and 141,000. So we get our charges for the year is 1,066,500. As for the furniture, we got it is 112. For the truck or the vehicle, we got it is 901,687.50. So the total will be 2,110,000. Then eliminated on disposal, we have two. So we have the truck and the machinery. For the truck disposal, we got for the 2 years it is 124. So we have that one for the 124, and for the machinery we have calculated it after disposing the 187 for the 2 years, get 37. So that is all what we are supposed to do. So after we got this, so we need to add this. We add these two, subtract that, we get balance as at 30 April 2011. Now we are going to get the 5 million. The same for the furniture, for the motor vehicle, and then the total amount, we are going to get that. So that is balance as at 30th April. What about now the net book value in the same year of the 30th April 2011? So we are going to get the balance as 30th April 2011. We subtract the depreciation of 5 million. So we get 8,916,000. We go to the furniture. So the 9 million, we subtract the 412 of 500, we get 487. The balance as at 13th April for motor vehicle, we subtract the 2 million, we get 1 million. Then the net book value as at 1st May 2010. So here we are going to get this, only the balance as at 1st May 2010, we subtract the depreciations. This one, the accumulated depreciation. So 13 minus 4 million, you are to get 8 million. 900 minus 900 minus this one 300, you get 600. 35 25 minus 1470, we get 25, as well as the total after you have added all that. So this is what you are supposed to do for that question on protected plant and equipment movement schedule. So I can give you a minute to check on the to look at the solution for that and get some screenshot, as well as take the for the workings. So we have the workings there, so I can give you a minute for each. Okay, another thing that I wanted to check, since I am given you the format, it is sale ledger control and purchase ledger control account. So let's look at the sale ledger. We shall start with the sale ledger, and then we do purchase ledger, but in the same question we shall tackle these two using this question. So we are told ABCD Limited maintains control accounts in its business record. The balance and transaction relating to the company controls account for the month of December 2014 are listed below. So we have the balances as sale ledger, their debit and credit, and purchase ledger, same debit and credit. Then we have the transaction during now the December. So we have the sales on credit, as you can see, and the amount. Purchase on credit, return inwards, outwards, bill of exchange payable, bill of exchange receivable, checks received from customers, checks paid to suppliers, cash paid to suppliers, bill payable dishonored, charged on bill payable dishonored, cash received from credit customer, bad debts written off, cash discount allowed, bill receivable dishonored, balance at December. We have the sale ledger, it's credit, and purchase ledger, it's debit. So the first thing we should do, it is get we are going to start with the sale ledger. So we are going to tick all the things that we are supposed to put on the sale ledger, and the rest shall be put on the purchase ledger. So let's go directly. So a minute so that you take the screenshot for that question. So you have done that. So you are told post the trade receivable and trade payables ledger control account for the month of December 2010 and derive the respective debit and credit closing balance on 31st December 2010. So if you consider the format that I gave you, it will be very direct to understand what goes on the debit and what goes on the credit. For the sale ledger, shall have the title ABC Trade Receivable Ledger Control Account. So we are going to start with the balance brought down. As you can see from the question, from the C ledger, we have the debit and the credit. So we are going to take the debit of 6,185,100. Then on the debit, we always have the credit sales and also the bill receivable dishonored. That is also on the debit sale. Another one that you can talk about is the refund to customers, dishonored checks, bad debt recovers. So those are on the debit. On the credit, we talk about the credit balance, total cash received, total check received, return inwards, cash discount allowed, bad debtors, written off, cash received, purchase ledger contra, all that. So if you have the format, everything will flow. So we are going to write the credit side on the debit side and bills receivable dishonored on the debit, since they are supposed to be written on that side. So on the balance brought down, we on our sale ledger, on our credit side, from the question you have been told it is 52,500. So you input the 52,500, you record that. Then all the things that are recorded on the credit side, we can start with the return inwards for 203, bill receivables, all the income. So we have the bill receivables, checks received of 7 million, cash received, bad written off for 64, discounts allowed. So when you total this, you're going to get 14,769,500. So on the credit side, it will be less. So that's why we are going to bring the balance carried down. So we are going to bring the balance carried down of 5,394,000. So this is the total debit balance carried down on our side, on our sale ledger. So I think that is enough. So any question on the sale ledger? The first thing to do is to understand the things to be recorded on the credit side and things to be recorded on the debit side. With that information, everything else will flow. So on our purchase ledger account, we're also going to have to do the same. So everything that was left will be on our purchase ledger. So ABC trade payables ledger account. So here we are going to start on the debit side and the credit side. As we understand, on the debit side, we have the total debit, total checks paid, cash discount received, say ledger contra, total returns, outwards, all those. On the credit side, we also have the credit balance, credit purchase, refunds from supplier, all that. So we are going to use that information to know what to record. So we start on the debit side. The balance brought down, as you can see from the question, we are told is for 16,500. On the credit side, it's for 4,200,000. So we input on the credit side that. So then on the debit, we have to indicate to record all these: the return outwards, the bills payable, checks paid, cash paid to suppliers. They are all on the debit. When you come to the credit, we have the credit purchase, bill dishonored, charges on the bill disbursed. So all these are the things required on the credit side. So after you have recorded that, you find the total on both sides. So on the credit side, we have 10,406,000 and 500. The same comes to on the debit side. So the debit has less amount, so it will have the total credit balance. to be brought on the debit side of 4,355,000. So this is the total credit balance, as we can see. So any question pertaining this purchase ledger account? Sellers, don't forget the balance carried down. It was on the purchase ledger where we had been told it was debit. So 23,500. You also need to indicate it. On the sale ledger, we did not have the debit. We only had the credit, which was supposed to be carried down. I think you have taken some notes on that. So any question, please consult me on the comments. So let's go to the final illustration. I'd like we talk about the bank reconciliation statements. As I gave you the format, so I'd like we look at the an example. So on July 10, Joseph Kahiga, sole trader, received his monthly bank statement for December 2005. The statement shown as follows. So you have the balance, debit, credit, the balance. So the balance was 186,200 on December 1. So as you can see, we have some checks on electricity. So those are the debits. We also have those one on the credits. So dividend, loan check, Jemima, all these are check. Miscellaneous, credit, the study in order. So if they are expense, you can see on the debits. So income, revenue, liability, they are on the credit side. So this is a bank statement. So I can give you a minute, get a screenshot on it so that you can be able to discuss on it. So bank charges, loan check deposit, all that, as well as the balances for the bank. Then we also have the Joseph Kaiga cash book. So what is what he showed on his cash book. So balance brought down. We have this one on Solomon Kagai. On the credit side, we also have the electricity, the check number, and the amount. So a minute. So you can do that. You can also take a screenshot on that. Then we are asked, John required Joseph Kahiga's updated cash book as at that 1st December 2005 and Joseph Kahiga bank reconciliation statement as that 5 December 2005. So we are going to look at the amount. We are going to start with the cash book. So we look at the things that are on the cash book, but they are not on the bank statement. So we can start with the updated cash book. So the title, we are going to have Joseph Kahiga updated cash book as at 31st December 2005. So it's our T account. So from our cash book, the balance brought down was 179,300. So here, as you can see, there are things that are on the bank statement, but they are not on the cash book. So we are comparing things on the bank statement, but they are not in the cash book. So we have like dividend. Dividend is not on the cash book. So we are going to debit that since it's our income. So it is increasing the assets, so we debit that. Another thing that you can see that is on the bank statement, but it is also not in the cash book, we have the standing orders, bank charges, and also direct debit. So all these, they are liability, so we're going to credit them. So we credit that. So 3,200, bank charges for 1,800. You also have the direct. Direct debit of 8,800. So the total or the balance figure will be, and the debit is 181,900, should be equal on the credit. So the balance figure, it is 168,100. So this is the updated cash book balance that we are going to bring on the bank reconciliations. So after noting that the things that are not on the cash book from the balance statement, so we have dedicated all of them. So then we are going now to calculate or to show our bank reconciliation statement as at that 1st December. So balance as per cash book updated. So this one, the one that we have brought forward, carried down. So it will be 168, 100, 168, 1,000. Let me confirm that. Okay, so the balance as per cash book updated, it is 168, 100. Then we have to either use the we have to format on bank reconciliation, the one that we earned and presented checks and the errors, and we erase uncredited checks and the errors, or we earned uncredited checks and errors, and we erase unpresented checks and errors from the banks. So let's start with this one for the unpresented checks. So we are going to look at those checks that have not been presented. So they are on the cash book, but they are not on the balance bank statement. So as you can see, we have some checks that are on the cash books. We have this one for Victor Kalanja, Steve Madia. So they are not on the bank statement. So those are the unpresented checks. So we write both of them and the amount. So the total will be 10,800. When we add that, get 178. Then we are going to less uncredited checks. So we have those checks that have not been credited by the bank. So we have one for Owen Duby and Water Oyubi. So this one on the debits, yeah, they show that they have not been credited by the bank. So we raise that. So the two will total to 23,200. After raising, you get 155,700. So this will be the balance at bank as per the bank statement. So that is all about the bank reconciliation. So you can get a minute, get some screenshot notes pertaining that. So that is all what you are supposed to do. And remember to take one format. You don't need to combine both format when calculating for reconciliation or showing the reconciliation format. So thank you. If you have any question, please comment below. I can also offer some personalized study. Just comment on the YouTube below and I'll reply, come back to you. So thank you and see you.